$91 a barrel in a single day. Crude oil just posted its biggest weekly gain since 1985. Not since 2008, not since COVID, since 1985. And the reason it happened is sitting 21 miles wide in the Persian Gulf, right? Now completely shut down. March 2nd, 2026. Iran's Revolutionary Guards declared the Strait of Hormuz closed and threatened to set ablaze any ship that attempts to pass through it. That waterway carries 20% of the world's entire oil and gas supply. And right now, it is a declared war zone. This started on February 28th when US and Israeli jets hit Tehran and killed Iran's supreme leader. Within 48 hours, the strait was closed. Oil was exploding, and a metal that most people are not even watching yet just had its biggest setup in 4 decades, quietly activated. That metal is silver. And by the time you finish this video, you are going to understand exactly why a closed shipping lane in the Persian Gulf just opened a window toward $200 silver, and why that window will not stay open forever. CBS News published this on March 6, 2026 today, and wrote, "Silver could realistically hit or even surpass the $200 per ounce record this March." This is not a gold bug forum. This is not a YouTube channel. This is CBS News asking the $200 question out loud. If you are new here, subscribe right now and hit the bell, because this channel covers exactly these moments before the mainstream catches up. And drop a comment telling me where you are watching from and what time it is right now, your city, your state, your country. I want to see how far this video is reaching, because what we are breaking down today affects every dollar you own regardless of where you live. And while you are down there, give me your answer. Does silver hit $200 before the end of 2026? Yes or no? I read every single comment. Now let us get into why this is real. Reuters confirmed on March 4th at least 200 ships, oil tankers, LNG carriers, cargo vessels, all sitting frozen in open water off Iraq, Saudi Arabia, and Qatar. Not delayed, not rerouted, anchored and stranded because the waterway ahead of them has been declared a shooting range. CNBC reported on March 6, using data from freight analytics firms Ineta. 147 container ships are sheltering inside the Persian Gulf right now, trapped on the wrong side of the strait. And Maersk, the world's largest shipping company, published an official notice on March 2nd stating, "We are suspending all vessel crossings in the Strait of Hormuz until further notice. The safety of our crews, vessels, and customers. The gate is shut." The world's biggest shipping company said it out loud. Now here's where most people stop paying attention, because they think this is just an oil story. It is not. What happened in 72 hours was not one crisis. It was 3 separate critical energy systems failing at the exact same time. Reuters reported that Qatar, the world's largest LNG exporter, fully shut down gas liquefaction and declared force majeure on shipments. Their exact words? Qatar will fully shut down gas liquefaction on Wednesday and won't return to normal production and exports for at least a month. That is a natural gas crisis stacking directly on top of the oil crisis. And then Reuters confirmed this. Saudi Aramco's largest domestic refinery and key crude export terminal, Ras Tanura, was struck on Wednesday. The world's single biggest oil export terminal, hit by a projectile, in the same 72-hour window as everything else. Strait closed, Qatar dark, Ras Tanura struck. 3 systems, 72 hours. Simultaneously. That is the scale of what just happened. And now here is the part that should stop you cold. Because the silver $200 case does not start with this week. It started 5 years ago, and this week just lit the fuse. Here is a question you need to sit with right now. If silver was already running out of supply before the war started, before any of this, what happens to its price when a global energy crisis lands directly on top of that shortage? The Silver Institute, the industry's primary research body, published this on February 10, 2026, 3 weeks before the first missile was fired. Their exact words? The silver market is expected to remain in deficit for a 6th consecutive year in 2026. Mine is noteworthy 67 million ounces. And in 2025 alone, the shortage was 117.6 million ounces. The world has been consuming more silver than it produces every single year since 2021. The war did not create this shortage. The war arrived when the shortage was already 5 years deep. That is the foundation the $200 case is built on, and the geopolitical shock is just the accelerant. The same report confirmed that physical silver investment is forecast to rise 20% in 2026 to a three-year high of 227 million ounces. More investors buying, less metal available, a six-year deficit deepening, and a war-driven energy shock now arriving on top of all of it. Now let me walk you through exactly how Hormuz closing connects to $200 silver. Because this is the mechanism most people miss entirely. And once you understand it, the $200 number stops sounding crazy. There are three channels. Channel 1 is inflation. Oil at $91 means transport costs go up, manufacturing costs go up, food prices go up. That feeds into CPI. Rising CPI forces the Fed to hold interest rates higher for longer. Delayed rate cuts mean cash loses purchasing power in real time. When cash loses value, money moves into hard assets, gold, silver, physical commodities. That rotation has happened in every single major oil shock for the last 50 years without exception. Channel 2 is industrial demand. And this is the channel that makes silver specifically different from every other safe haven asset on the planet. Reuters reported on February 19th and quoted Ben Damiani directly. In the U.S., silver-based costs per 450-watt module have increased from roughly $5.22 in early 2025 to about $17.65. That is a 238% increase in silver costs for just one solar application. Silver is inside solar panels, semiconductors, EV components, military electronics, and AI chips. It is not decorative, it is functional. It cannot be easily replaced. When its price rises, those industries do not stop buying. They pay more because they have no choice. Channel 3 is safe haven rotation. The same fear that is bidding oil to $91 right now is also flowing into physical precious metals. Gold already confirmed this. It surged past $5,400 following the strikes. And here is the critical point. When gold runs hard, silver runs harder and faster. Always. Because silver's market is a fraction of gold's size, the same wave of capital hits a smaller pool of metal and the price moves more violently. The moment the strikes hit, silver spiked to $96.22, its highest level since February. Disruption banking headlined it. Iran war sparked gold surge, past $5,400, silver to $96. That move happened in hours, not days. Hours. From $84 to $96 before most people had finished reading the news. Then it pulled back hard. Finance magnates reported, silver crashed below $84 on Tuesday, erasing Monday's Iran war spike from $96. A brutal 13% two-day reversal. And right now there are people looking at that number and concluding the silver rally is already finished. That conclusion is the most expensive mistake you can make right now. And here is exactly why. That pullback was profit-taking on a momentum spike. Pure and simple. Traders who rode the initial move from $84 to $96 took their gains and exited. That is normal market behavior, but ask yourself, did the Hormuz Strait reopen? No. Are those 200 ships moving yet? No. Is Qatar back online? No. Did the Silver Institute's 6-year deficit disappear? No. The underlying pressure that caused the spike did not reverse. Only the short-term momentum reversed. Those are two completely different things, and confusing them is what keeps retail investors on the wrong side of every major move. In 1979, when Iran's revolution cut off oil flows, silver was sitting at around $6 an ounce. 14 months later, it had reached $50. That is documented history. Today's setup has something 1979 never had: a pre-existing structural deficit, embedded industrial demand across green energy and defense sectors, and a market that already proved in 2025 that it can run from $29 to $121 in a single year. Now let us build the $200 number with actual math. Not hype, not hope, real numbers. The gold to silver ratio as of March 1st, 2026 sits at 61.43. That means it takes 61 ounces of silver to buy 1 ounce of gold right now. In the 1980 crisis, the ratio compressed to 17. In 2011, it compressed to 32. If gold holds at current levels, and the ratio moves only to 45 minus, conservative compression silver trades above $120 right now. If the ratio moves to 32, where it has gone before in sustained monetary crises, silver moves above $170. If gold continues rising, which JP Morgan, Goldman Sachs, and the Federal Reserve's own policy trajectory all support, and the ratio compresses to historical crisis levels, $200 silver is not a prediction. It is a ratio calculation on a chart that has existed for 100 years. JP Morgan Global Research published this forecast. JP Morgan Global Research sees silver prices averaging $81 per ounce in 2026, more than double its average in 2025. That forecast was set before February 28th. Before the strikes, before Hormuz was closed, before Ras Tanura was hit, before Qatar declared force majeure, JP Morgan's $81 was the bullish case for a normal year. This is not a normal year, which means $81 is not a ceiling anymore. It is a floor that was set in a world that no longer exists. 3 days before the strikes, Reuters reported JP Morgan raised its long-term gold forecast to $4,500 and kept its 2026 year-end target at $6,300. Banks were already moving their numbers in a pre-war world. What do those numbers look like now that the war is real and the strait is closed? That is the honest $200 case, not a Reddit thread, not a YouTube prediction, a ratio calculation, a pre-existing deficit, an industrial demand floor, and institutional forecasts that were set before. The single biggest geopolitical disruption to energy markets since 1985. Now here is what you need to do with this information, depending on where you are standing right now. If you already hold physical silver, your position is being validated in real time by every data point we just covered. The 6-year deficit did not change. The industrial demand did not change. The ratio compression thesis did not change. What changed is that a massive external catalyst just arrived. Patience is your edge right now. The biggest mistake physical holders make in volatile moments is selling into a short-term pullback and exiting a long-term correct position. If you are on the trading side, silver moving from $84 to $96 and back to $84 in 48 hours is not chaos. That is a defined range with documented institutional tailwinds behind it. A clear entry level with a known risk threshold is a setup, not a warning sign. And if you are sitting on cash right now, watching this unfold and asking whether you already missed the move, you have not. CBS News published the $200 question this morning. The Silver Institute confirmed the deficit 3 weeks before the war started. JP Morgan's $81 floor was set in a pre-war world. Silver is sitting at $84 right now, with Hormuz still closed, Qatar still dark, Ras Tanura is still damaged, and a 6-year supply deficit still in place underneath all of it. The window in this title is not the $96 spike from Monday. The window is the structural setup to this crisis just put in plain view. And that window does not close until the strait reopens, the deficit reverses, and the industrial demand disappears. None of those 3 things are happening this week. One more thing to watch closely. The COMEX exchange, where silver futures contracts are physically settled, is experiencing documented delivery stress in the March 2026 cycle, with a 43.1% first-day delivery rate flagged on March 3rd. To be clear, this is not a COMEX default, and anyone claiming the exchange is collapsing is getting ahead of the evidence. What the data confirms is that physical demand for actual silver delivery is elevated. Registered inventory is tight, and the exchange is under pressure it has not seen in years. That is an additional layer of tightness on top of everything else. Here is what to watch over the next 60 to 90 days. First, does Hormuz reopen to commercial shipping? Reuters quoted BIMCO's chief security officer directly, providing protection for all tankers operating in areas currently threatened by Iran is unrealistic, as this would require a very high number of warships and other military assets. Every week that strait stays effectively closed is another week of sustained pressure on oil, on inflation, and on the silver thesis. Second, watch the Fed's March meeting. If oil-driven inflation data forces the Fed to hold rates or signal delayed cuts in 2026, hard assets including silver get a new structural floor they did not have a month ago. Third, watch the COMEX March delivery cycle complete. Physical stress is documented and real. The outcome of this delivery period matters. The world that existed on February 27th is gone. Goldman Sachs raised its Brent forecast by $10, In a single update on March 4th, JP Morgan's silver ceiling is now its floor. The Silver Institute confirms 6 straight years of deficit before a single update. Shot was fired, and silver is sitting at $84 with all three catalysts, geopolitical, structural, and industrial, live and active simultaneously. That combination has not existed in this market since 1980. Drop your location in the comments right now. Your state if you're in the US, your country, and local time if you're watching from anywhere else. I want to see where this is reaching, and give me the only answer that matters today. Does silver hit $200 before 2026 is over? Yes or no? That is your comment. Subscribe and hit the bell. The next video covers the Qatar LNG force majeure. What a month-long natural gas shutdown means for the second wave of this energy crisis, and what it does to silver's industrial demand equation. That story connects directly to everything we covered today, and it is just getting started.